I want to tell you about something happening right now in American banking that almost nobody is discussing publicly. Not on CNBC, not in the Wall Street Journal's front pages, not in congressional hearings, but in private conversations, in hushed meetings between regulators and bank executives, in the confidential memos circulating through the Federal Reserve. There's a single question that keeps coming up. How many more are going to fail? Since March 2023, 5 major American banks have collapsed. Silicon Valley Bank, Signature Bank, First Republic, Silvergate, and Republic First. Combined assets of over $500 billion vanished in a matter of weeks. The second, third, and fourth largest bank failures in American history all happened within 2 months of each other. Now, you might think that's behind us. The Fed stepped in. The FDIC provided guarantees. The crisis was contained, right? But here's what they're not telling you. Those failures weren't anomalies. They weren't isolated incidents caused by mismanagement at a few reckless institutions. They were symptoms, warning signs of a structural problem that hasn't been fixed. It's been papered over, hidden, postponed, and the clock is ticking. Let me explain what's actually happening, because the truth is far more disturbing than the official story you've been told. And I should warn you, once you understand the mechanics of what's breaking in the American banking system, you'll realize why Wall Street won't talk about this openly, because talking about it might accelerate the very crisis they're desperately trying to prevent. Let's start with a simple question. What broke in March 2023? Why did Silicon Valley Bank, an institution that had operated successfully for 40 years, suddenly collapse in 48 hours? The official explanation focused on mismanagement, poor risk controls, concentrated depositor base, all true. But those were the symptoms, not the disease. The real cause was something far more fundamental, something that affects hundreds of other banks right now. Here's what happened. For over a decade, from 2008 to 2022, interest rates were near zero. The Federal Reserve kept them there deliberately to stimulate the economy after the financial crisis and again after COVID. In that environment, banks did what seemed perfectly rational. They took deposits and invested heavily in long-term government bonds and mortgage-backed securities, safe assets, treasury bonds, government-guaranteed mortgages, nothing risky. A bank might buy a 10-year treasury bond paying 1.5% interest, completely safe. Backed by the full faith and credit of the United States government, they'd hold thousands of these bonds, collecting steady, predictable interest. But then something changed. Inflation surged in 2021 and 2022. The Fed responded by raising interest rates faster than at any time in 40 years, from near zero to over 5% in less than 18 months. And here's the thing about bonds that most people don't understand. When interest rates rise, the value of existing bonds falls. Think about it this way. If you own a bond paying 1.5% interest and new bonds are paying 5%, your bond is worth less. Who wants to buy your 1.5% bond when they can get 5% elsewhere? If you need to sell that bond before it matures, you have to sell it at a loss, sometimes a substantial loss. Now, this wouldn't matter if banks could just hold those bonds to maturity. Eventually, they'd get their money back, but banks can't always wait because banks operate on deposits, and deposits can leave. Silicon Valley Bank had $175 billion in deposits, much of it from tech startups and venture capital firms. When those depositors got nervous and started withdrawing money, the bank faced a problem. They didn't have enough cash on hand. Their assets were tied up in bonds that had lost value. To meet withdrawal demands, they had to sell bonds at massive losses. On March 8, 2023, Silicon Valley Bank announced it had sold $21 billion in securities at a $1.8 billion loss. They tried to raise capital to cover that loss, but the announcement triggered panic. Depositors rushed to withdraw. Within 48 hours, $42 billion fled the bank. It was a classic bank run, just conducted digitally at the speed of smartphones and wire transfers. By March 10th, Silicon Valley Bank was insolvent. Regulators seized it. The 16th largest bank in America had collapsed in 2 days. Now, here's what keeps me awake at night. Silicon Valley Bank wasn't unique in holding long-term bonds that had lost value. They were just the first to experience a run. Analysis by economists at the University of Southern California found that if we mark all bank assets to market value, reflecting current interest rates, American banks are sitting on over $600 billion in unrealized losses. $600 billion. Think about that for a moment. The entire banking system is holding securities that, if they had to sell them today, would generate losses of more than $500 billion. But as long as they don't sell, as long as depositors don't panic and demand their money back, those losses remain hidden. They exist only on paper, in the gap between what banks paid for bonds and what those bonds are worth today. This is what accountants call an unrealized loss. It's real. It's just not recognized on the books until the asset is sold, but the potential is there, lurking, waiting, and it's not spread evenly. Research shows that smaller and mid-sized banks are far more exposed than the giants. Banks with assets between $50 billion and $100 billion. Regional banks that aren't quite big enough to be too big to fail, but are substantial institutions holding billions in deposits for businesses and families in their communities. Let me tell you about a bank I won't name, but it's real, a regional institution in the Midwest. They serve small businesses, farmers, local governments. For years, they invested conservatively in treasury bonds and mortgage-backed securities, safe assets, exactly what regulators encouraged. They're now sitting on unrealized losses of nearly 15% of their total assets. Their capital cushion, the buffer that protects them from insolvency, is barely 8%. If even a modest portion of their depositors decided to withdraw funds simultaneously, they'd be forced to sell bonds at losses that would wipe out their capital. They'd be insolvent. Are their depositors panicking? Not yet. Does the local business community know how precarious the situation is? No. Is the bank doing anything illegal or unusual? Absolutely not. They're simply caught in the mechanics of rising interest rates, destroying the value of bonds purchased when rates were low. And they're not alone. The FDIC, in its confidential assessments, has identified dozens of institutions in similar positions, not failing yet, not insolvent yet, but vulnerable. One shock, one loss of confidence, one large depositor withdrawal away from crisis. Now, you might ask, why don't they just raise more capital, sell stock, bring in investors, strengthen their balance sheets? Here's the problem. Raising capital means admitting weakness. It means publicly acknowledging that unrealized losses are a threat. And the moment you do that, you risk triggering the very panic you're trying to prevent. It's like being in a crowded theater and smelling smoke, but being afraid to shout fire because you know it will cause a stampede. So you stay quiet, hope the smoke clears, and pray nobody else notices. This is the warning Wall Street won't talk about. Not because they're conspiring or hiding the truth maliciously, but because talking about banking fragility in public can become a self-fulfilling prophecy. If people believe banks are in trouble, they withdraw deposits. Withdrawals force asset sales. Asset sales realize losses. Losses trigger insolvency. The prophecy fulfills itself. So there's a conspiracy of silence. Regulators know, bank executives know, sophisticated investors know, but publicly everyone maintains confidence. Everything is fine. The system is sound. Nothing to worry about except it's not fine. And here's why the situation is more dangerous now than it was in March 2023. First, interest rates remain elevated. The Fed has cut rates slightly, but we're still far above the near zero levels of 2020. Those bond losses haven't disappeared. They're still sitting there, embedded in balance sheets across the banking system. Second, the commercial real estate crisis is unfolding. Office buildings in major cities are half empty. People work from home. Companies need less office space. Property values are collapsing in some markets. Banks hold hundreds of billions in commercial real estate loans. Many of those loans are going bad. Defaults are rising. This creates actual losses, not just unrealized ones. Third, and this is crucial, the implicit government guarantee that saved depositors in March 2023 may not be available next time. The FDIC stepped in and guaranteed all deposits at Silicon Valley Bank and Signature Bank, even deposits above the $250,000 insurance limit. They did this to prevent contagion, to stop panic from spreading to other banks. But that decision was controversial. Critics called it a bailout. Politically, it's much harder to do again. If another bank fails, will the government guarantee all deposits, or will they let uninsured depositors take losses? The uncertainty itself is destabilizing. Fourth, the economic environment is deteriorating. Growth is slowing. Unemployment is creeping up. Consumer debt is at record levels. Credit card delinquencies are rising. Auto loan defaults are increasing. When the economy weakens, loan losses increase, and banks with thin capital cushions have no room for error. Let me give you the human dimension of what this means, because banking crises aren't abstract. They destroy lives. There's a small manufacturing company in Tennessee, 50 employees. They make parts for the auto industry. They've banked with the same regional institution for 30 years. They keep $3 million in their operating account. Payroll, supplier payments, everything runs through that account. If their bank fails, what happens? The FDIC insures $250,000. The remaining $2.75 million in limbo. It could take months to resolve. Meanwhile, they can't make payroll. They can't pay suppliers. The business grinds to a halt. Employees lose jobs not because the company failed, but because their bank failed. Multiply that across thousands of small businesses. That's the real cost of banking instability. Not just numbers on a balance sheet, but jobs, livelihoods, communities. Now, the defenders of the current system will tell you I'm being alarmist. They'll point out that the vast majority of banks are well capitalized and stable, that regulators are closely monitoring vulnerable institutions, that stress tests show the system can handle shocks. And there's truth to that. Most banks will survive. The giants like J.P. Morgan, Bank of America, Wells Fargo are not in danger. They're too big, too diversified, too closely monitored. But the banking system isn't just the giants. There are over 4,000 commercial banks in the United States. Many are small, community-focused institutions. They hold trillions in deposits. They provide credit to businesses and families, and dozens, perhaps hundreds, are in precarious positions. The question isn't whether every bank will fail. The question is how many more will fail, and whether those failures will be contained or whether they'll trigger broader panic. Here's what we know from history. Banking crises don't announce themselves with sirens and flashing lights. They develop quietly, a bank here, a bank there. Each failure is explained as unique, specific to that institution's particular problems, until suddenly there are too many failures to ignore and confidence evaporates. In 2008, Bear Stearns failed in March. Lehman Brothers failed in September. In between, everyone kept saying the crisis was contained. It wasn't. The system was riddled with bad mortgage debt. And once confidence broke, the crisis spread like wildfire. Are we in a similar situation now? The honest answer is we don't know. The unrealized losses are real. The commercial real estate problems are real. The economic headwinds are real. Whether these factors combine to trigger a broader crisis depends on confidence, on whether depositors stay calm, on whether regulators can manage failures without sparking panic. But here's what I can tell you with certainty. The structural vulnerabilities that caused Silicon Valley Bank to fail haven't been eliminated. They've been deferred. The fixes that would actually address the problem, requiring banks to recognize losses, to raise capital, to reduce exposure to interest rate risk, those fixes are painful. They would force banks to shrink lending, raise borrowing costs, potentially trigger a recession. So instead, we're gambling. Gambling that interest rates don't spike again. Gambling that the economy doesn't weaken too much. Gambling that depositor confidence holds. Gambling that we can grow our way out of this before the next shock hits. And maybe we'll win that gamble. Maybe rates will fall, bond values will recover, commercial real estate will stabilize, the economy will strengthen, and in a few years we'll look back and say the warnings were overblown. But what if we don't win? What if another bank fails next month? What if depositors at similar institutions panic and start withdrawing? What if the FDIC doesn't guarantee uninsured deposits this time and businesses lose access to their operating funds? The cascading effects would be devastating. Credit would freeze, businesses would fail, unemployment would surge, the Fed would be forced to cut rates and restart quantitative easing, risking inflation. we'd face the worst of both worlds, financial crisis and economic stagnation. This is the warning Wall Street won't talk about. Not because it's secret, but because acknowledging it openly risks making it worse. So they speak in code, in careful language about monitoring emerging risks and ensuring adequate capital buffers. But the risks are real. American banks are quietly failing. Not all of them, not even most of them, but enough to reveal that the system has cracks, and cracks under pressure become fractures. We're living through a slow-motion banking crisis. It started in March 2023. It hasn't ended. It's just moved underground into the realm of unrealized losses and deferred problems and crossed fingers. The question now is whether we have the wisdom and the courage to address the underlying problems before they explode into the open, or whether we'll keep pretending everything is fine until the day it very suddenly isn't, because that's how banking crises work. Gradually, then suddenly, everything seems stable until the moment it doesn't, and by then it's too late. The warning signs are there. Unrealized losses, commercial real estate troubles, economic headwinds, regulatory uncertainty, political constraints, each one manageable in isolation, but together they form a pattern that anyone who's studied financial history recognizes. I don't have a crystal ball. I can't tell you which bank fails next or when, but I can tell you that the conditions are there, the vulnerabilities are real, and the silence from Wall Street isn't reassuring. It's ominous.